Hi all. In this video we'll take a look at areas of high volume that develop during the trading day. Now first let's just define what we mean by an area of high volume, and this may sound a little obvious, but an area of high volume occurs when a large amount of trade occurs at one or more prices. Now, okay, that's pretty simple, but a lot of people will think that this means that was actually more trading than usual in that period, and that's not the case. So we can have an area of high volume without an exceptional amount of volume trading. We see high volume areas in the market when trading no longer causes price to move, or when it takes a lot more trades to move through each price. So on crude here, we might average 40 contracts to move through each price, but then something changes and now it's taking 200 contracts to move through each price, and that's exceptional volume. Now what we're looking at here is crude oil from March 6, 2017. And each of these circles here that we see here, they all represent areas where a lot of volume traded. And these areas of high volume are significant from a trading perspective. Many reversals that you see in the markets are preceded with an area of high volume like this. Now, not every reversal will have an area of high volume, but certainly enough that every trader should understand what's going on here. So let's first look at this area over here, where we can see we have a vertical move up that's followed by an area of high volume. Now, if we think about this fast move up here, what exactly is that telling us? Well, it's telling us that the buyers were in control, obviously, but it's also telling us that the offers, the sell limit order side, they were getting out of the way. And we know that partly because of the speed of this move, and partly because there's no exceptional volume there. So if the sell side limit orders were stepping up, we'd actually see exceptional volume trade through those prices. Now we got up to 53.50, and we can see there we've got exceptional sell side liquidity. We can see a number of consecutive prices with exceptional volume. So what we know then is that the traders with sell limit orders stayed firm as the buyers carried on buying. So we also know that at that time the buyers are effectively getting stuck. So it should be no shock that that was the end of the move. And as we move down, the buyers that bought at the end of this move are going to get stopped out, and that's effectively what's helping you move to the downside. The sellers won that battle. Now, as we move down to 53.20 down here, we can see two areas with lots of buyer liquidity here, 53.20, and here around 53.15. Now, what's interesting about these two areas here is that they are both head fakes or false breakouts. Now, the first thing you need for a head fake is something to break out of. So in the first example, we can see that 3 times we moved up from this level around 53.23. So this area here is temporary support. Now the market pushes through that support, traders think that level is broken, and then they sell it, but after moving down a few ticks, we see the buyers absorb the selling. So we see 323 sell market orders with no move down, and that is exceptional volume. And that's also a fairly good signal. If you're trading head fakes, that's a fairly good signal to fade that move. Although in this case, if you did buy that price, the market didn't follow through that much, and that's just trading. Now on the next push down, we fell short of that low, but we pushed down again. Exactly the same thing happened again. So we broke down, we broke through the support level, and again the buyer stepped up and absorbed the selling, and that was effectively the end of the move down. Now the key with these head fake moves is that you need an area to break out from, followed by a breakdown, followed by the opposite side absorbing all the buying or selling. So in both cases, you can see these circles are mostly red, which means in terms of sell market orders, there was an imbalance on the sell side, and those sellers were getting trapped. Now there's not a lot of buying here because the smart buyers are the ones with their bids in at this price. Okay, and that's one of the reasons that you actually see an absence of buying in these moves. So if you play breakouts, you have to be aware of this kind of activity, because if you played a breakout of this move, when you saw the sellers start to get trapped here, that is where you need to be getting out of your trade. That is where your breakout is effectively failing. Okay. If you play the head fakes themselves, obviously you need to know where the sellers are stepping up and absorbing or trying to hold the market. Now, what's that's followed with is a huge move up. Now, I don't think this huge move up was anything to do with this seller absorption here. It's too big and it's too fast. Now, I'm not exactly sure what triggered this move, but it looks very similar to a move initiated after a news event. Now, we all know that news events tend to trigger wild, swingy moves in the market, and a lot of people presume that's because a lot of volume's traded. And what actually happens if you watch the market just before a news release is that all the liquidity, all the limit orders just disappear. So we might see an average of, say, 50 contracts a level normally, but that shrinks to less than 10 a level before a news release. And this shrinking is most evident closer to the current price. So the closer we are to the current price, the smaller the bids and offers. So all the liquidity disappears. So in turn, it doesn't take a lot of trading to move the market. And that's why you see this vertical move with no large volume. Now, as I mentioned, that shrinking liquidity is most evident close to the market. So as we continue up, we move into an area where the liquidity didn't shrink so much. So now the market thickens up. Traders on the limit side, far from the market, haven't pulled out of the way, either intentionally because they actually want to sell there, or because this move up was so fast they didn't actually have time to move out of the way. So you see this very, very common pattern after a news release, which is a vertical move up and then this wide spread of prices with exceptional size. And the key to playing these moves, or the key to trading these moves, is to let that play out. You don't actually need to guess where the move will end, and you obviously can't just trade the first few circles. What you do know is there's a very good chance that a move like this simply can't be sustained, and that when the market starts moving down, the buyers are going to get stopped out. So some of these late buyers up here will, without doubt, be in the market simply because they got so excited by seeing this move up that they got into the market. They literally thought that they were missing out. They saw the move up, they weren't in that move up here, they saw it move up here, they saw it move up some more, and they got to here and I've got to buy it. I can't stop myself from buying it now. I'm missing something. And those guys are going to be some of the first traders to bail out as the market pushes down. So as you can see, these areas of high volume aren't all equal. So the head fake itself is a relatively calm affair. You know, the absorption is going to occur at maybe just one or two prices. For these vertical moves that are driven by some kind of news event, whether that's a planned news event or some kind of random news event, you know, something that just comes out of the blue, we tend to see a vertical move, and then we see a spread of high volume, mostly because of that excitement factor. Traders think the market's just going to the moon because it's moving so fast, and it takes a while for that excitement to die down. Traders realize they're getting trapped. Not all reversals are caused by high volume, but it is really worth studying high volume areas because they really do provide clear opportunities when they do occur. But just bear in mind, if you get in just because of high volume, it's going to be pretty hit or miss. If you actually let the market move against these traders a little bit, you actually have a much higher probability trade. So anyway, good idea to take a look at high volume areas. If you do have a look at it, we'd love to get some feedback from you. Thank you.